Like and subscribe and click the bell icon to get new video updates.
Higher interest rates and mortgage repayments will be the new normal for homeowners in 2022. Analyst says the Reserve Bank's 25 basis point increase is just the first of many on the horizon, and Queensland homeowners need to brace for higher home loan repayments over the next 18 months, a leading property analyst has said. Traditionally, interest rate hikes have a cooling effect on the housing market. However, demand continues to outstrip supply in parts of Queensland. The central bank's rate rise was its first in more than 11 years, taking the official cash rate target to 0.35%. CoreLogic Research Director Tim Lawless said while a single increase would be manageable for most people across Queensland, further rises would put pressure on household finances. The median value of a house in Brisbane is about $771,000, so the typical loan size if someone's got a 20% deposit, would be nearly $617,000. This latest 25 basis point rate hike means the typical mortgage for a new borrower would be about $81 higher per month. But of course, as we see rates rise more, say for example if we see interest rates go up by 100 basis points, then that is adding $332 per month to the typical mortgage, which is becoming more material. Mr Lawless said higher mortgage repayments would become the new normal for borrowers in 2022. The RBA will probably be lifting rates every month all the way through to the end of the year, so all of a sudden, you're getting a cash rate that is already up by say, 150 basis points, Mr Lawless said. It won't be too long before we see the cash rate normalising, getting back to average levels, or maybe even getting beyond that. Queensland's housing market nation-leading Property Council of Australia Chief Executive Ken Morrison said that traditionally interest rate hikes had a cooling effect on the housing market, however demand continued to outstrip supply in parts of Queensland. When you do have interest rate increases, that does have a dampening impact on sentiment, so I would expect whether you are in southeast Queensland or elsewhere in the state that will come into play, Mr Morrison said. There is also supply and demand, and supply is a real challenge. He said the COVID-19 pandemic saw people moving to regional areas and an influx of homeowners from southern states to southeast Queensland. The housing supply pipelines have really been dried up, Mr Morrison said. Mr Lawless described Queensland's housing market as nation-leading, with values surging in the last year. We're seeing, for example, Brisbane housing values are rising at nearly 6%, quarter on quarter, and across regional Queensland, it is about the same rate, it is about 5.8% quarter on quarter. What that means is somebody in Brisbane has added about $175,000 to the median value of their home just over the past 12 months. Mr Lawless said rapid interstate migration was the main driver behind the strong demand for housing, especially in southeast Queensland. But he added that over time, the combination of higher interest rates and elevated house prices would exacerbate affordability issues and naturally slow the state's housing market. I think the simple reality is more and more people will be looking towards the medium to high density sector, Mr Lawless said. Read more. Even just over the past 12 months in Brisbane, unit values have risen at about half the rate of house values, so it is a much more affordable alternative. I wouldn't be surprised if people go towards things like townhomes, or low-rise or even high-rise apartments, as their first home and build some equity and upgrade after that. He said the higher density market would also attract property investors. Yields on units are much higher, they tend to be in Brisbane at least at 4.6% compared to houses, which are yielding about 3.3%, and the buy-in price is much more affordable as well, Mr Lawless said. Using Brisbane as an example, the typical house price in Brisbane is about $880,000 and the typical unit price is about $490,000, so it is a saving of hundreds of thousands of dollars to get into a unit instead of a house. Businesses may delay spending plans. Professor Sean Bond, from the University of Queensland's Business School, said the Reserve Bank's decision would also increase the cost of borrowing for businesses, which comes after several very tough years, due to the COVID-19 pandemic. Professor Bond said he expected businesses might pull back on spending. They will be looking closely and may potentially put projects on hold or delay spending plans, he said. He said the rate rise was unlikely to have an immediate impact on the construction industry, which was struggling with building supplies and increased costs. Eventually the Reserve Bank will be hoping that this rise, and potentially future rises, will take some of the heat out of the